Welcome to The Explainer. Today we're digging into a really fascinating equity research report that looks at the quantum computing market and highlights what it calls a massive arbitrage opportunity.
All right, let's get right into it. The whole report kicks off with a real head-scratcher, a gigantic valuation difference between two key players in the quantum space that, on the surface, seem to be running the exact same race. And here are the two companies. On one side, you have the public market leader, IonQ, with a pretty staggering market cap of $17.6 billion. Then, on the other side, there's a company called Inflection, which is about to go public, valued at just $1.8 billion. I mean, that's an almost 90% discount.
So the analyst behind this report is basically saying, hey, this isn't just a small gap, this is a profound market dislocation. So what's going on? Let's unpack the core arguments for why they think this gap exists, and maybe, just maybe, why the market has it all wrong.
Okay, so the first piece of this puzzle is pretty interesting because it actually has nothing to do with quantum computing. It's all about how the challenger, Inflection, is making its money right now, today.
And get this, a whopping 70% of Inflection's revenue comes from something called quantum sensing. We're not talking about some far-off computing dream here. This is the real-world sale of actual hardware, stuff like atomic clocks and super-precise navigation systems.
The report has a great name for this, the dual-pillar defense mode. The idea is actually pretty simple, but it's really powerful. One pillar is the stable, growing business in quantum sensing that's bringing in real cash. And that cash, it's used to fund the second pillar, the more speculative but incredibly high upside research into quantum computing.
And we're not talking about some theoretical customer base. The customers buying this sensing tech are major government and defense clients, the DoD, NASA, allied governments. They need cutting-edge tech that works in places where GPS can't. So you end up with these sticky, multi-year contracts that really de-risk the whole company.
So we've got the business model down. Now let's talk about the core technology itself. This is where the second part of the report's argument really comes into play. The huge technological bet that could, potentially, let Inflection leapfrog its competitors. But first, a super quick refresher. A qubit is the fundamental building block of a quantum computer. You can kind of think of it like a bit in your laptop, but on steroids. It's exponentially more powerful. The whole game in quantum is about getting more qubits and making sure they're also super high quality.
And this gets right to the heart of what the report calls the modality war. IonQ uses a method called trapped ions, and they're known for being incredibly high quality, or what we call high fidelity. Inflection, on the other hand, uses neutral atoms, and the report argues that this approach has a huge advantage when it comes to scalability, the ability to pack a massive number of qubits together.
Yeah, the analyst literally calls this neutral atom approach the Goldilocks zone. The argument is that it hits that sweet spot, combining some of the best features of different methods. The big one, though, is the ability to arrange qubits into these vast 2D and even 3D structures, which is way harder for other technologies to pull off.
And this isn't just on paper. They've actually done it, at least in part. Inflection has already demonstrated arrays of 1,600 physical qubits. I mean, that is a massive number. According to the report, this basically solves one of the most fundamental pieces of the entire scalability puzzle.
Which brings us right back to the core of the report's thesis, the money. Why is a company with this kind of technology and a stable business valued so much lower than its main competitor? Okay, here's where the rubber really meets the road. If you look at how much investors are willing to pay for each dollar of sales, the difference is just, well, it's stark. Investors are paying about $156 for every single dollar of IonQ's past revenue. For Inflection, just $50. That's a 3x difference in the multiple alone. It's huge. But the report says, wait a minute, this valuation gap ignores a supercritical metric for any startup, especially in a crazy expensive field like quantum. How efficiently are you actually using your cash? So, check this out. Even though they brought in $29 million in revenue, Inflection only burned through $21 million in the last year. For a deep tech hardware company, that is incredibly low. The report frames this as a sign of a much healthier, more sustainable business that isn't just setting fire to piles of investor cash.
Okay, but let's be real. No investment thesis is all sunshine and rainbows. We have to look at the risks. And the report is very clear that this whole potential opportunity is not a sure thing. There are significant hurdles that could derail the entire story. So risk number one is the big technical one. The report calls it the Achilles heel of this whole neutral atom approach, gate fidelity. And that's basically just a fancy way of talking about the error rate of your quantum calculations.
Now, when you look at these numbers on the screen, that difference looks tiny, just a fraction of a percent. But, and this is a huge but, in the world of quantum computing, the journey from 99.7% to 99.9% is exponentially difficult. So if Inflection can't close this fidelity gap, its massive advantage in the sheer number of qubits could be rendered totally useless.
And the second major risk, it has nothing to do with physics, it's all about finance. Inflation is going public via a SPAC. And if you follow the markets over the last few years, you know that SPACs, well, they got a pretty bad reputation. They've often been highly volatile, and many have performed really poorly after the merger is done.
So you weigh those very serious risks against the potential upside, and the analyst's conclusion really boils down to these three key points. First, that valuation gap is just too big to ignore. Second, the sensing business provides a really strong safety net. And third, the neutral atom technology has that massive upside potential.
Ultimately, the report's bottom line is this, that established sensing business provides a strong floor for the company's value, which means, according to the analyst, investors are basically getting a free option on the explosive, potentially trillion-dollar future of fault-tolerant quantum computing.
Which leaves us with the final question this report poses to investors. Is Inflection a deeply undervalued asset hiding in plain sight, a true quantum arbitrage? Or does the market see that fidelity gap and the SPAC risk correctly, and that 90% discount is perfectly justified? The analyst has made their case, now the market gets to decide.